The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. We'll be beginning in just a moment. Good afternoon. Welcome to CAGP's special webinar presentation, Canada's New Estate Donation Rules. Understand, get ready. Sponsored by Miller Thompson and presented by Brenda Lee Kennedy, Doug Puffer, and Ruth McKenzie. My name's Erin Kuhns, and I'm the Professional Development Coordinator at CAGP, and I want to thank you all for being here today. Just before we get started, I have a few housekeeping items. We do welcome your questions about today's webinar. There will be a Q&A period at the end of the presentation, and you will notice a question box on the control panel of your screen where you can type in your question. We just ask that you begin each question with the name of the presenter whom you are asking. Your control panel on the right-hand side of your screen can be hidden at any time by clicking on the arrow in the small red box near the top of the control panel, and then you can pull it out again by clicking on the arrow again should you wish to ask the question later. As mentioned in previous emails, you may either use your computer speakers to listen to the webinar or you may call in. Should you decide to call in, however, please be aware that for many of you, the phone number will be long distance and not toll-free. For those of you who have a Twitter account, we invite you to share your favorite tips from today's webinar using hashtag #CAGPWeb. And just to remind you that as with all of our webinars, today's presentation will be recorded and you will receive an email with a link to the recording within 24 hours. Also, within the next 24 hours, a PDF copy of this presentation will be available on our Webinar Wednesdays website page. And now I'd like to first introduce Amanda Stacy with Miller Thompson, who would like to bring greetings on behalf of our sponsor.
Good morning to those of you out west, and good afternoon to those of you in the east. Miller Thompson is proud to be sponsoring today's webinar on the new estate donation rules. These are some of the biggest changes we have seen to the estate donation tax regime in many years. While the new rules bring welcome flexibility regarding the timing of the use of donation tax credits in an estate, they also bring added complexity and uncertainty, particularly where the estate is complex or where the estate is the subject of a dispute. Today's webinar is timely given that we only have 8 months to go before we have to start grappling with these rules for real as they come into force. So I am looking forward to our speaker's presentation today. Thank you very much.
All right, thank you so much, Amanda. Now I'd like to introduce our presenters. Brenda Lee Kennedy is partner, charity, and not-for-profit and high net worth planning group with PricewaterhouseCoopers. Doug Puffer is Director of Planned Giving with Simon Fraser University, and Ruth McKenzie is the Executive Director of Canadian Association of Gift Planners. So I thank you all for being here today, and so Brenda, I will let you take it from here.
Thanks so much, Sharon. Welcome. This webinar is being presented to bring you information on recently enacted tax legislation which will impact how testamentary gifts will be treated effective January 1st, 2016. Doug, Ruth, and I will provide a legislative overview and speak how donors and charities might be impacted by these legislative changes and what you can do now in order to ensure that testamentary gifts already planned for and those that will be planned can incur as intended and not be put at risk. We'll speak about ways in which donors, charities, and professional advisors can have productive discussions about these upcoming changes and whether changes need to be considered in estate plans and how you can be strategic about these changes. And lastly, we'll explain what CAGP has been doing to address the new legislation. I'll start off with a legislative overview of the current rules for testamentary gifts as they work today, and this will inform you about how the changes starting January 1st, 2016 can affect testamentary gifts in Canada. Currently, the tax regime for testamentary gifts provide that a gift by will is considered to have been made immediately before a donor's death. Generally, a gift will be considered a gift by will if it is one that is made as a consequence of someone's death, if the terms of the will or the testamentary instrument provides for a charitable gift of a specific property, a specific amount, or a specific portion of the estate residue, and where the executors have no discretion and are obligated to make the charitable gift. And of course, if the charitable gift is actually made at some time after death. Where these conditions are met, donation tax credits are claimable against the donor's death taxes, traditionally those that are associated and reported on the donor's terminal or last tax return, and or with respect to his taxes for the year prior to death. Where the testamentary gift qualifies as a gift by will, the value of a non-cash gift for donation tax receiving purposes begins with the fair market value of that gifted property or asset at the donor's date of death, even though the actual transfer of the property to effect the gift happens after the donor's death. In contrast, if the testamentary gift is not a gift by will, but is a gift that is made by the estate where the executors have the discretion to make that gift, this would be an estate donation, and tax relief can be claimed against the estate's income, but not used by the donor against his or her terminal tax return taxes. A qualifying gift donation, as just discussed, should be distinguished from a distribution from an estate to a charity that is a capital beneficiary of a estate. In this case, there is no donation tax credit available to the estate. So now we'll talk about gifts by will, designated gifts, and estate donations for deaths after December 31st, 2015, what we call the new estate donation rules. Under the new tax regime for testamentary gifts, the charitable gift will be considered to be made by the estate and not by any other person or taxpayer at the time that the property is transferred from the estate to the donee or the charity. This covers gifts by will, beneficiary designated gifts of RSPs, RIFs, TFSAs, and life insurance, as well as estate donations. This means that the value of a charitable gift for donation tax receiving purposes will be the fair market value of an asset at the time it is transferred to the donee or the charity. Where a gift is made by an estate that is referred to as what we call a graduated rate estate, whether you affectionately or unaffectionately refer to it as agree, there will be an ability to apply the donation tax credits over a number of taxpayers and number of taxation years. The tax credits could be applied in that situation against the donor's terminal tax year taxes, the taxes of the donor for the year immediately before the year of death, the tax year of the agree estate in which the donation was made, or prior tax years or of the agree. However, to avail the estate from the sprinkling of these donation tax credits across the estate or across the donor and multiple taxation years, the transfer of the property that is the subject of the gift must be made by the agree estate must be made within 36 months of the testator's date of death. It must be made using assets owned by the testator at his or her death or a substituted property. Estate donations that are not qualifying GREE donations once made will also be eligible for donation tax credits by the estate in the year in which the donation is made by the estate and the asset is transferred to charity, and for any of the carry-forward periods associated with donation gifts. But they will not be eligible for the flexibility of sprinkling those donation tax credits across multiple taxpayers and multiple tax years as it is with a GREE donation. We'll also note that there's a legislative change which speaks to the gift to publicly listed or publicly traded marketable securities, ecological property, and cultural property made as a consequence of death of a donor. And while they will continue to qualify for nil capital gains inclusion, they will if they are gifted from a GREE estate. And for your benefit, we've listed here what a GREE estate is. And it generally includes an estate that arises as a consequence of someone's death, qualifies as a testamentary trust as that term is defined in the Income Tax Act, and is one that exists for no more than 36 months from the date of an individual's death. Additional administrative matters will also have to be provided for in order to qualify the estate as a GREE estate, and that includes providing the social insurance number of the deceased individual, as well as designating that particular estate or trust as a GREE on the first estate return that ends after 2015. So when we address testamentary charitable giving and ask the question, why the statutory shift and why the legislative change, we talk about looking at what was contemplated by the Department of Finance in the first place. The charity sector in the past has identified to the federal government that donation tax credits in certain situations could go unused, either because there was no estate planning or where the testamentary instructions did not provide for a qualifying gift by will, or where there was a mismatch between where the gift was made and which taxpayer experienced tax liability against which the donation tax credit could be used to reduce or eliminate tax. There is also some concern by charities and by the CRA that donation tax receipting wasn't always considered the value of the gift to property at the donor's date of death, which is a requirement under the current rules, because of a gift by will being considered to have been made just prior to the donor's death. As well, the Department of Finance was in the midst of legislating tax reform for testamentary estates, what it calls graduated tax estates, and capping the number of tax periods in which an estate can claim marginal tax rates. So Finance decided to connect testamentary gifts with this concept of GREE estates. And while we can see the upside of testamentary gift tax reform, we do see that in certain situations, certain estates will benefit from the flexibility of using donation tax credits over multiple years and by two different taxpayers, being the individual and his or her estate. But the tax legislation also puts a cap of 36 months from the date of death in which the transfer of a gift of property has to occur. So executors may look to administering their estates and expediting the transfer of property in order to secure the donation tax credits for the testator. With legislative reform, though, there are potential drawbacks, and the downside of testamentary gift tax reform in Canada will cause certain planned testamentary gifts, both either in size, timing, or in absolute amounts, at risk in situations where the estate administration is delayed, for example, because of estate litigation, the probate process, or the tax clearance certificate process, or where, for certain reasons, the executors are unable to transfer assets to charity within the 36-month period. Also, estates where assets are complex cannot be easily monetized or gifted as is, or where there is inadvertently the gifted asset is not part of the testator's agree estate or is part of another trust structure, you'll be in a situation where it may be difficult to achieve the tax relief associated with testamentary gifts in the right hands. Consequently, we'll see many situations where testamentary gifts under the new rules are at risk of not happening or of not being planned for, because advisors and planners will share with donors that their testamentary gifts may not produce the desired results for themselves or for the charity. So at this point in time, I'd like to turn it over to Doug, who will address opportunities and approaches to addressing this discussion with donors and charities and their advisors.
Well, good morning, good afternoon, and good day to everybody. All right, here we go. All righty, well, I'm going to give you the charity perspective on what I feel and what a lot of my colleagues in the charitable sector feel is taking some of the worst aspects and some of the best aspects of the changes. And I can't help but think that we've got a brand new word in the genre of gift planning, and I'm not sure whether it's a verb or a noun, this word "gree," but if it were past tense, it might spell something a little bit different. On the upside, it's a very short list, but let's have a look and see what we can do. Now, working on the next slide. And I can't seem to move the slide. There we go. Okay, now I've got control. Okay, I'd say on the optimistic outlook side, we're hoping that finance will fix the problems associated with this, with the charitable tax credits, and in accord with the letter that CAGP has put forward that Ruth is going to be talking to you about. To my mind, the real big problem is around the 36-month timeline. Realistically, I expect that finance will listen to our problems, but they're going to be vested in the work that they've done and likely defer any decisions on amendments. On the pessimistic side, we're stuck, and their changes will achieve their intended result, which I believe is more taxes and less charity. So let's not stick with the policy, but it really seems like the new policies in regard to this tax reform are kind of contrary to the existing rules, which were designed to encourage giving through estate planning. So. So what I'm going to talk about a little bit is about the charity challenges that we're going to be facing and some of the opportunities. One, I can honestly say that when I first saw this, I was not exactly struck by the opportunities that are going to be presented by the new legislation. But after going through it with a couple of colleagues who I'm eternally grateful for their optimism and outlook, I think it does give you an opportunity to communicate with your donors and to be very, very transparent with the changes. I would say that we're at least stuck with these rules for a while, and it's important for gift planners and people who work in the charitable sector to be very transparent and open with your donors. I wouldn't hold back on this for too long. Just to give you an example, the newsletters that I send out semi-annually will have a message this time about the fact that I'm concerned about the gift plans that some of them may have in place. If there's any thoughts of litigation or complexities around the estate, that it may not be fully liquidated, shall we say, within that 36-month timeline, that they should really have take this opportunity and review their gift plans and their estate plans with their advisors, who are now getting up to speed with the regulatory changes. We've looked at revising all of our marketing and service material, all the brochures that we've got, and take a look at them in regard to the new rules that we're going to be faced with. One of the changes that I feel quite unfortunate is putting an emphasis more on specific gifts. As most of us know in this business, specific gifts are generally not the really big ones. The big ones are the residual gifts. But can we risk undoing a gift plan by waiting for a residual gift when the entire estate plan may be centered around tax planning using charitable giving? Residual gifts often aren't given out until after they've got clearance from the CRA. And if you take into account the time period that it takes for probate and a clearance certificate, you're really dealing with about 13 months in which to liquidate all the assets of an estate and get a clearance certificate for a residual gift. So should we emphasize specific gifts? I think we have to have that conversation. Direct beneficiary designations may be a more palatable option for many people. You can, and perhaps it may visit a revival of gift annuities in Canada, especially for those of us who self-insure gift annuities. And gifts of residual interest in properties that can be done with both commercial and personal real estate. So that may be something that we should be looking at as well. But you're going to have to really bone up on your skills to work on those ones. Gift planners are going to have to build and develop better relationships and really close relationships with estate trustees and executors. This means you're going to have to develop your staff competencies in gift planning and estate administration, probably to a new level, so that you're conversant with the new rules, but also that you're going to be having a network of other professionals. Transparency is really going to be the big thing, but we're dealing in an area of uncertainty about some things. Oh, I think I have to go back one. Okay. So the second aspect of the challenge we face is a review of the charity's policies and competencies about gifts in kind. Because if we can't get an estate executor to liquidate all of the assets, we may have to be prepared to offer the option of donating an in-kind gift. And I would say a lot of organizations are not prepared with appropriate policies for a gift of major assets. And I'm thinking mostly real estate, commercial real estate, private shares, a number of different aspects of your donors' estates are going to be in complex assets. And that's what we're looking at. So I would say that you're going to have to really bone up on your skills and bone up on policies and develop your competencies in handling gifts of complex assets. Complex assets aren't the only thing. I think we need a little bit more opportunity to propose diverse gifts of assets so that we can be in compliance with the 36-month rule. Now, the messages going out to donors and their executors. If your estate is going to be simple, if it's a relatively easy thing, personal property and a principal residence and maybe a vacation home without really any major family issues or other assets, you're going to be able to settle within 36 months. It's not an unreasonable timeline, and I think maybe that's some of the rationale behind imposing a 36-month timeline for this. It's also going to give a message out there saying, if you really want to to take full advantage of the charitable gift receipts and the planning, that you're going to have to provide some direction to executors. So as a person creates their will, maybe they're going to have to give thought to selecting a professional co-executor, or at least directing their executor to hire an agency which can handle these kind of transactions. As I said before, we're going to have to give consideration to specific gifts versus residual gifts. Perhaps in the wills, they're going to have to instruct their executors to declare the GRE, the GRE, because that's going to have to be declared in the will, and in the T1 terminal return, you're going to have to declare that with the social insurance number in order to qualify for a graduated rate estate. Donors are going to have to instruct their executors to make charitable gifts as soon as possible, right after probate, or in some cases even before, depending upon the nature of the gift. They're going to have to instruct their executors to gift in kind if it's necessary. Sometimes things like investment funds, which are part of an estate, could be the entire investment asset goes to the charity rather than waiting to cash it out and look after the transactions after the fact. Charity distributions are going to have to be made before clearance certificates are issued. And perhaps donors can consider a little bit more lifetime giving and direct beneficiary designations. But I don't know about you, but in my experience, a very challenging discussion to be had about a current gift of assets when they're needed for a lifetime. So I'm not so sure that that's going to be the favored position. Charity gift planners. Okay, here's where we go. You're going to need to develop proactive communication with your donors. As I said before, we put an open article in a newsletter about the graduated rate estate and what it means and what we advise our donors to do. We're going to be talking to all of our confirmed donors in the form of a letter or in phone conversations or in person to advise them about this and to make sure that are going to get some good advice from their advisors over the next little while, and hopefully they're going to talk to their advisors about working with us. We're going to do a proactive outreach with executors as soon as possible. We've got new printed material available for them. We're going to be sending it immediately when we're advised of a gift in the will. And this is challenging because we're not always advised in good order, so it can be very challenging for us to deal with lay executors. I think everybody needs to devise a calendarized estate management systems, and whether your database software and ours are similar, but I don't see a lot of it out there that it's really extraordinary. So I would suggest you develop a really good, solid network of with other professional advisors in the field and get that moving as soon as possible. And I can't emphasize strongly enough the networking you're going to have to do with advisors. Join the estate planning councils in your area. Build your knowledge. Get your experts to write articles for your newsletters. And we're going to need each other's knowledge more than we ever did in the past. No question about it. And here's my messages for professional advisors who are dealing with estates and their philanthropic clients. Please review your existing plans under the old rules. If you look at the plan, is it based on donations deemed to have been made immediately before death? Because that plan may not be a workable one anymore. And the new flexibility around the rules may provide a positive approach to that. And I would encourage you more to work with charity gift planners. I know we deal a lot in confidence with our clients and with our donors, but I would say that if you look at a charity gift planner as another professional who can help you, we'll do a much better job together for your clients and our donors. If your clients and donors have assets in spousal, alter ego, and other life estate trusts, Well, the assets become mismatched now with the charitable gift tax credits. This is going to be a problem, and you'll see in the case study that we're going to be bringing up towards the end of this in my presentation that this is an issue that we're going to have to be dealing with. I would say help your clients to deal with complex assets during life. Is there something that we can do to better prepare them to facilitate your client's philanthropy? Please develop your liaisons with your clients and charities. Put them together as partners. Put us all three together in a room to discuss giving different kinds of assets. A lot of us are in good position to accept gifts of real property and private shares, and if there's a plan in place to liquidate private shares or use them as part of a succession planning in your giving, then let's talk together, please. Current giving rather than bequests, as I said before, is kind of a difficult conversation for many of us to have, but maybe the lawyers and financial advisors are in a better position to do that with their clients, because there's very often a more holistic outlook in the planning that you do compared to the planning that gift planners do, because you have a better picture of your client's whole asset base. We want to look at opportunities to discuss direct beneficiary designations, investment accounts, insurance policies, retirement funds. All of those, plus a lot of others, can be given a direct beneficiary designation, so they go outside the probate process, and they wouldn't be subject to this, but they can still benefit the graduated rate estate through tax receipts that can be issued relatively quickly to the estate. And there's going to be an urgency for estate trustees as professionals to attend the details of donors' wills. Delays could mean that the graduated rate estate inadvertently loses the status for charitable tax credits. I'd say for lawyers and estate professionals who are approached by amateur executors and estate trustees, they really do need to advise them on a quick basis. Okay, so now we get to a little bit of fun. I went through one of our files at SFU, and it's a testamentary trust. It's a little bit of a test case, I guess you could say. But what I'm going to do is I'm going to ask Brenda and Amanda to unmute their microphones and join in at with the discussion on this case. So here we have a testamentary trust which was created 18 years ago by Ian Smith. It was a vacation home with some investments, and it created a life estate for his son, David. SFU is the sole residual beneficiary. The trust pays all the upkeep, taxes, repairs on cottage, plus an income for David. But it wasn't a qualifying charitable remainder trust because it was allowed to take some capital out in the case of need. The date of death cost basis for the cottage was $150,000. The investment account was $275,000. The current value of the cottage is $550,000, and the investment account is now at $300,000. So here's some of the questions that came up in my mind when I read the file. So when David dies, Ian's will states that the remaining assets in the trust shall fall into and form part of the residue of my estate. But with the new graduated rate estates, there's some changes to trust law as well that we really haven't had a chance to look at today. But I'm gonna see if we can't get a bit of a conversation going about whether this is actually going to happen now, because the capital of the trust may in fact be affected. What is Amanda? What do you think?
Well, I think we might be okay on this one because the rules that you've referred to that have changed in tandem with these donation rules are the rules around the taxation of spousal trusts, alter ego trusts, common law partner trusts, and certain other types of trusts that are similar. on death of the surviving spouse, if you will. And just briefly, what's changed is that where a testator would set up a spousal trust for a spouse for his or her lifetime, you would have a deferred transfer of assets into that trust. So you wouldn't have a tax event when that spousal trust was set up. When the second spouse dies, that's when you'd have your deemed disposition, if you will, and the tax would be paid out of that spousal trust. What's changing is that the tax is now going to be the responsibility of the second to die, the second spouse's estate, which is not where the assets are to pay that tax hit. But here in your example, this isn't a spousal trust. So I think that we're in the old regime, if you will, that on death, on Ian's death, any tax in the trust will be the responsibility of the trust. And keep in mind that when this trust was set up, it wasn't done on a tax-deferred basis. There would have been the deemed disposition in the estate on David's death, and then the trust would have received the assets at fair market value on date of death.
Right. Okay. Well, that answers the really the first question there for sure. And I was just wondering if the new trust rules have got any bearing on the way the 21-year anniversary rules. Have been any changes in that regard? And if there is, what planning do you think can be done to mitigate that looming tax hit, which I've roughly calculated is going to be $103,000 in 3 years, which is it's an entire third of the investment account. So, Brenda, do you have any comments on that one?
The legislative changes on testamentary trusts and on testamentary gifts, or what we call the estate donation rules, haven't spilled over into changes for the 21-year rules. A trust such as this, which is subject to its 21st anniversary in a few years, typical planning has been to look at whether or not the trust provides for an ability to have a capital distribution, so-called an encroachment on the capital of the trust, in order to not have that asset there in the trust after the 21st anniversary. And whether or not in this situation that can be done is really subject to a good review of the trust terms and conditions. But typically, if you are stuck in a situation where you're going to end up having no distribution of trust capital, and therefore you're going to have an asset with appreciated gain there on the 21st anniversary, you're right, you're going to have to contend with crystallization of some assets in the trust in order to pay the tax bill. And in this situation, if the only significant asset with value is this particular cottage, you're going to be into an issue of having to fund that tax liability, and whether that has to speak to the monetization of that vacation or recreational property or some of the investments. I'm not certain what the best plan is for this one, but you definitely have challenges whether or not you're looking at this trust being subject to down the road the new estate donation rules and or the access to assets in order to pay for the 21st anniversary death tax or 21st anniversary trust taxes.
Right, right. Now, the last question before we turn it over to Ruth is, so if the residual beneficiary is a charity, can a trust be converted to a qualifying charitable remainder trust, Amanda?
Well, if you've got the permission in the trust document to encroach, then I think you're out of luck on this one, because that's not something that can be changed. I can't see recommending to a client in a similar situation that they would go to court or something of that nature to try and get that encroachment removed, because that would clearly have been the testator's intent, that there be some capital available if needed for the life tenant. So it would be very hard to, if not impossible, to purify a trust, if you will, to create a CRT after the fact.
Thanks very much. Thank you both for your comments. I got one last slide before I turn it over. Okay, so in sum, gift planners, you're going to have to be realistic and accept the rules the way they are and hope for change, but I wouldn't delay it. This is the new regime we have to live with and deal with accordingly. I would strongly recommend you review your files. Look for files like the Ian Smith Trust, and you know, there's a half a dozen files that I know of in mine that are all spousal trusts. So I'm not so sure the spouses know what's coming in this case, and it's up to us to take care of it. Nobody has all the answers yet, as there's a lot of questions being posed about it. Next comment is quite appropriate in my mind, but I would recommend that you go to the CAGP conference in April 22, and I'm not doing this as a promotion for CAGP because, quite honestly, you're not going to learn about this stuff anywhere else other than CAGP. You can learn a lot of the technical aspects through STEP and state planning councils and bar associations, but for charitable organizations, you're not going to learn about this anywhere else. The knowledge that we're dealing with is not an option, and I was a little bit surprised at the number of people who register for this conference who have the name gift planner in their title who are not members, and I think you should probably join. Okay, Ruth, it's all up to you now.
Thanks, Doug. And good morning or good afternoon to everybody who's on the call. I wanted to share a little bit of information with you today about what CAGP is saying to the Federal Department of Finance on this issue. We made a submission on the 4th of March. We felt it was really important to bring to the attention a few of our serious concerns with regard to the new rules. While we knew the department had received a lot of feedback on the effect of the new rules on taxpayers, little had been received on the impact on registered charities. So our recommendations focus on ensuring charities are not disadvantaged and that the full value of intended gifts is available for public benefit. And we focused our submission in 4 areas: testamentary charitable giving, gifts of publicly listed securities, cultural property and ecological property, tax liability and life interest trust, and tax receipts generally. So the first issue, testamentary charitable giving. In regard to the change that we saw in this new legislation, you've heard a little bit about it already. They contain significant changes to the tax treatment of testamentary charitable gifting for deaths occurring after 2015. This legislation introduces flexibility in that the donation tax credit can be allocated by the executors of a GRE among a number of tax periods, namely the last taxation year of the deceased donor, the tax year preceding the year of death, the tax year of the GRE in which the donation is made, and prior taxation years of the GRE. And I got a tweet earlier about asking what a GRE is, so I'm going to make sure I don't use the acronym. That's a graduated rate of estate. CAGP strongly supports the increased flexibility to allocate the donation tax credit across a number of tax periods. However, our concern is that the conditions for an estate donation to qualify for an estate donation tax credit treatment include the following: that the property must be transferred by a graduated rate estate, the transfer must occur within 36 months of the date of death, and that the property being donated must be property acquired by the estate on or as a consequence of death. An estate will continue to be able to claim donation tax credits in respect of other donations in the year in which the donations are made, and in each of the following 5 years. While this new flexibility introduced by the legislation permitting donation tax credits to be claimed by 2 taxpayers, that being the deceased and the graduated rate estate, over a number of taxation years is a welcome change. The conditions that have been introduced may make it challenging to realize the tax benefits which are related to charitable donations made by the estates, and thus reducing the amounts available to a charity through a testamentary gift. The most significant issue raised by the new legislation is the timing of the gift, and more specifically, the concerns are that in order to access the flexibility of allocating the tax credit among several years, the transfer, my slide changed forward.
Yeah.
Okay.
I don't know if somebody's accidentally.
Somebody might be changing my my slides by mistake. In estates of any but the most modest assets, as you've heard, the time frame is just too short. Where more complex assets are involved, it can be challenging to administer the estate within the 36-month framework. And finally, there may be other delays in administrating an estate, such as litigation. Tangible assets, such as gifts of real estate or works of art, are involved. The executors may be forced to sell at reduced prices in order to reach the timeline. And there's no mechanism for the extension of the 36-month deadline. So these issues raise really significant concerns for the sector, and the uncertainties may mean that many Canadians will be less likely to include a charity in their estate plan. So our proposal is simple. Retain the new flexibility for the allocation of a testamentary gift, but remove the linkage of that flexibility to a GRE in two ways. The first, allow the executors to allocate gifts made by the estate to the designated years when the gift is made, and allow the gift to be made by an estate, whether it's a GRE or any other kind of estate. And, sorry, just changing my slide. Okay, so the next is gifts of publicly listed securities, cultural property, and ecological property. The change is that the new legislation stipulates that the exemption from tax on the capital gain realized on gifts of publicly listed security will only be available to graduated rate estates in the future. Our concern is that the exemption has been tied to the nature of the property gifted. It's unclear why such gifts made by an estate that is not a graduated rate estate would be ineligible for this exemption. It should be available to all estates. Our proposal is that we're requesting that the exemption from tax on the capital gains realized on gifts of publicly listed securities, ecological property, and cultural property be available on gifts from an estate whether or not it's a GRE, a graduated rate estate. So tax liability in the life interest trust. This is a new rule in the legislation. In subsection 104.13.4, which provides that the liability for the tax realized on the deemed disposition of all the assets in a life interest trust at the time of death of the surviving beneficiary is in the estate of the surviving beneficiary. Previously, the liability was in the life interest trust. Our concern is that the subsection creates a year-end of the trust at the date of death and then deems the income of the trust in that year as payable to the deceased. The income would include income realized on the deemed disposition of assets within the trust, and this means that the taxation of income is moved from the trust to the deceased terminal return. The stated reason for the new legislation is to negate tax planning accessing more than one set of marginal rules. Unfortunately, the legislation as presented proposed unintentionally creates tax liabilities where none existed before. Charities are often the residual beneficiary of a life interest trust. Transferring the liability of the state to the surviving spouse means beneficiaries could be left with the tax bill while not receiving any assets. As a result, donors may be reluctant to name a charity as a residual beneficiary. So our proposal, we would suggest that it would be simpler to leave the taxation in the trust, but deem the residence of the trust to be the residence of the deceased beneficiary for the year of death. This would avoid the mismatch of the location of tax and assets and also avoid, in essence, a penalty on tax donations. So tax receipts generally, this wasn't an issue connected to the new legislation, but we thought we'd take the opportunity to raise another issue which creates challenges for charities related to tax receipts for charitable gifts. The concern is that it should be possible to issue charitable tax receipts to a charity named in a will or trust whether the charity is a capital beneficiary or whether the amount of the gift is set out explicitly. In wills or trusts where there's an intervening life interest, or spouse trust in a will being the most typical example, and the ultimate beneficiaries are registered charities, and the charities are simply named as the capital beneficiaries in the will or trust, the CRA takes the view that no tax credit is available. It's the CRA's position that a charity which is simply named as a beneficiary takes as beneficiary of the trust rather than as the donee of a charitable gift. At present, it's necessary to draft the will or trust so that the amount to be given to a charity is either set explicitly in the instrument or by way of formula, but the executor must be given the discretion to decide which charities are to receive the gift. This is artificial and unnecessary. Potential donors provided with this advice are often uncertain if their gift to charities that they wish to benefit will ultimately be paid, and as such, this policy leads to hesitancy in granting to registered charities in Canada. So CAGP recommends that if a registered charity is named as a beneficiary in a will or a trust where there is an intervening life interest and the registered charity is to receive a specific dollar amount, an amount determined by a formula or a percentage of the capital, that the manner in which the gift is described and whether the executor has any discretion in making the gift should be irrelevant in determining whether a donation tax credit is available. If any amount is ultimately given to a registered charity in a will or trust, a tax credit should be available. And as a few next steps, we're going to continue to dialogue with the Department of Finance. We want to advocate for changes that will ensure the implications for Canada's charities is well understood and that any negative impact is minimized. Doug mentioned our national conference. We're going to have some sessions on this topic, and we know there'll be a lot of discussion as it's a hot, interesting issue. And we invite you to keep connected to CAGP for ongoing updates on changes and our submission, and we commit to sharing best practices and moving forward on the new legislation. I'm more optimistic than Doug. I know that this government has been very supportive of the tax regime to support philanthropy, so we continue to keep our fingers crossed on their response to our submission. And I'm going to turn it back to Erin.
Great. So at this point, we will open the floor to questions. We have about 10 minutes. As I mentioned earlier, please begin your questions when you type them in with the name of the speaker to whom it's directed. I know we won't get to all the questions today, but we'll try to definitely at least reach a few. So let's start with Brenda. I think you have some questions there, Brenda. Brenda, can you hear me?
Yeah, I'm just trying to see the question.
Okay. You just pop out that box.
Right.
The questions box, and you should be able to see some questions there.
Okay. So the question is from Jan Ark. Is the relevant date of the execution of will or the date of death? And by that, I think, Jan, you're asking, is the relevant date for evaluation of the gift going to rely on the date of death, Gil, or the execution date on the will? It's actually neither. I think the new rules will contemplate that the value of the donation of a non-cash donation or an in-kind gift will be valued at the time that the gift is made to the charity, so that the time the property is actually transferred from the estate to the charity, as opposed to the current rules, which rely on the value at the date of death.
Do we want to move on to Doug for a question?
Sure, I'm ready.
Okay, go ahead.
Okay, there's a question from Jill. If the GRE has to be administered in 36 months, what happens to the tax relief if the estate is not finalized in 36 months. Well, the tax relief in that case, to my understanding, is that the tax relief only applies to income from the estate in the year in which the gift is made. It won't be carried back for the T1 return. I believe it can be carried forward for up to 5 years. The estate takes that long to handle, but basically it could very much unwind all of the charitable tax planning that had been undertaken from the estate. Thanks for the question, Jill.
Okay, so why don't we go to Amanda. I don't know if you see your question here, but I can...
I don't.
Okay.
Oh, wait. No, I do now. I'm so sorry.
Okay.
Okay, so for Amanda, can the credit be used by both the individual and the estate? So good question. Can we, if we don't use all of the credit, so I think the question is asking in a scenario where we would, say, apply as much as we can to tax in the terminal return, if we have some left over, can we then carry that forward and use it in the estate? I actually haven't thought about this specifically. I know that, so just thinking from the way the rules currently work, if you have excess donations, you currently can split them up across years, if you will. So my answer has to be that I imagine that you can do this, but I haven't checked specifically. I don't know, Brenda or Doug, if you had given any thought to this particular scenario.
I haven't.
I'm pretty sure, as I think about it, I'm pretty sure you could, but I wouldn't be able to give 100% certainty on that answer without just going back and looking at the rules with that in mind.
I would suggest that the flexibility of going backwards to the terminal return of the year prior to the date of death, as well as the tax year in which the donation is made by the Gray estate or prior taxation years. Plus you have, the presumption is you have the benefit of the carry forward rule 2, 5 years for ordinary gifts, 10 years for ecological or qualifying ecological gifts. So I would say that it's available there. Where I think it's not so much the sprinkling around if you haven't used the full donation tax credit in one particular year, like the terminal tax return, is this concept of if you do have a gift out of a graduated rate estate, it's making that transfer of property happen within 36 months of the testator's date of death, which will be a challenging part. Right.
Great, thank you. We have one that for Ruth. Over here. Yep. So there's a question about whether our communications materials or communications materials to donors would be made available, or does CAGP have templates that we could share? And I think that remains to be determined. We're committed to making sure that as best practices emerge, we're getting that out there. Whether we're sharing templates or not, I don't know. But I'd certainly invite you to stay connected to gift planning in Canada. We would likely have articles and so on in our publication that we partner with Kilborn and PG Growth on. And there may be some instances where actual tools and templates will be valuable, and we'll do our best to share them with folks. And we'll also be integrating these new kinds of materials in our various courses that we offer at the community level. So thank you for that question. Thank you. And like I said, I knew we wouldn't get to all the questions. There are some still, but I think we're going to have to tie it up there. I do hope today's webinar helps clarify a few things for you regarding Canada's new estate donation rules. And as Ruth mentioned, CAGP will continue to provide information and updates in regard to the new legislation as more information becomes available. In terms of follow-up questions, any questions can be directed to Ruth or CAGP members who have technical questions about the new legislation can always use our Ask an Advisor feature of membership by submitting their questions on the CAGP website under membership benefits. And just a reminder that by tomorrow you'll be able to download a PDF of this presentation on our Webinar Wednesdays webpage. I do invite you to join us for our regular series, Webinar Wednesdays. Coming up this week on Wednesday, March 25th, is a presentation by Lisa McDonald, editor of Gift Planning in Canada and AFP eWire Canada. She's presenting a webinar called Writing for Fundraisers, Make Your Donor Communications Sing. You can find more information on our website as well as the registration. And just one last reminder that there is still room to register for CAGP's 22nd Annual CAGP National Conference, taking place in Halifax April 22nd to 24th. And there's also our popular pre-conference Gift Planning All in a Day, which takes place on April 21st, also in Halifax. You can find more information about this on our website, or you're always welcome to contact me. So Brenda, Doug, Ruth, Amanda, thank you so much for taking the time to present this incredibly important information with us today. Please, you will see, you're going to see in your chat box a link to a final evaluation that I would ask that everybody just take a moment to click on and respond to. And in the meantime, I hope everybody has a wonderful week. Thank you.
Thanks, everybody.
Thank you. Bye-bye.
Bye.
Thank you.